Are we on the precipice of the massive AI bubble popping in the US here in late 2025? Well, we are now getting dramatic warnings from the CEO of OpenAI, from the former CEO of Amazon, from the CEO of Dell. They are all giving us warnings that the AI market is in a bubble and could collapse soon. And if it does, folks, this could have a massive impact on the stock market, on the economy. OpenAI's Sam Altman is now saying that he's seeing an AI bubble forming as industry spending surges. OpenAI, everyone, they own ChatGPT, in case you've used ChatGPT before. Well, OpenAI owns them, and their CEO is saying that he believes a bubble could be forming similar to the one that occurred in the 1990s. Specifically, he said, when bubbles happen, smart people get overexcited about a kernel of truth. Additionally, Jeff Bezos just came out and said that AI is an industrial bubble. Jeff Bezos is now calling it a bubble. He says the benefits are going to be gigantic, but Bezos is calling it a bubble. And now Michael Dell is saying this last week that at some point there's going to be too many AI data centers, also insinuating that it's a bubble. And why this is important, everyone, is because this AI bubble has really been the only thing propping up and fueling this economy in the last year. Spending on AI data centers accounts for almost all of our first half GDP growth, and the increase in consumer spending that keeps occurring in America, that's being driven primarily due to a wealth effect due to the stock market going to record levels each week, each quarter, which is primarily being driven by AI. So if AI is in a bubble, and if we're going to see that bubble pop, it could have dramatic consequences for our economy, for our stock market, for our housing market. And as I did the research for this video, everyone, I was shocked at the data I found at just how much money is being spent on AI right now, AI data centers and all the language models and the chips. You're going to be shocked when I show you just how much money is being spent. I was shocked at the percentage of our GDP growth that now comes from this spending. And I was shocked at just how much we're in a stock market bubble because of this spending. And let me just show you some of this data, everyone, because it's pretty shocking. Without the data center construction due to AI, according to Fortune, GDP growth was 0.1% in the first half of 2024, according to a Harvard economist. This Harvard economist basically showed that the increase, his name was Jason Furman, he showed that the increase in spending on information equipment and software was 25 to 30% year over year. And that if you strip this out of GDP, we basically had no GDP growth in the first half of 2024. So, this AI bubble, yeah, it's causing stock prices to go up, but it's also fundamentally driving our economy, driving GDP growth. Some of you are wondering, how has this economy not crashed yet? How have we not gone into an actual real recession? It's this AI bubble. It's the spending on data centers. It's the only thing really propping the economy up, especially with the housing market so weak. Right now, the housing market's really weak. The tech industry, actually, in terms of hiring, is weak. Finance is weak. But the AI bubble is driving things. And according to another article from Fortune, 75% of the gains, 80% of the profits, and 90% of the capex in the S&P 500 is coming from AI companies. 75% of the gains, 80% of the profits, 90% of the capex. And they quoted a Morgan Stanley analyst who was talking about this, and she basically issued a warning, and she's saying that this spending on AI, raising questions about its durability and as economic and competitive risks mount. And she's very concerned about the theme in markets. And the overall idea is like, could we be approaching what's called a Cisco moment? For those of you that don't know or don't remember, Cisco was the big company in the late 90s, early 2000s during the dot-com bubble. They were the NVIDIA of the time, Cisco was. And when they started to slide in 2000, 2001, that was the sign that the dot-com bubble was bursting. They had a couple bad earnings reports and the whole thing collapsed. Cisco was the world's most valuable company before an 80% stock plunge. This Morgan Stanley analyst is saying, could we be seeing something similar? How close are we to such a moment happening again. And one of the telltale signs, everyone, is what these AI companies and tech companies are doing in terms of the deals that they're striking with each other. There's some really strange stuff going on where OpenAI, they're the big one. They own ChatGPT. Sam Altman's the CEO. They're doing all these deals with other companies. OpenAI is doing deals with NVIDIA. They're doing deals with CoreWeave. They're even doing deals with competitors like they're doing deals with other competitors. NVIDIA is doing deals with AMD. All of these companies are doing deals with each other, and the revenue is kind of cycling around. It kind of looks a little bit like maybe a Ponzi scheme. I'm not saying for sure it is, but it's a little strange, everyone, what's going on here. Bloomberg actually broke this out. You guys should really look at this. Like, it breaks out all the companies involved here in AI and all kind of the incestual relationship here with revenue. Like NVIDIA's the big dog. They're the biggest company in the world right now, 4.5 trillion market cap. They have money coming in from XAI, but they also have money going out to XAI. NVIDIA also has money going into OpenAI, but of course, OpenAI is buying chips from NVIDIA. And all of these companies are kind of like doing these deals with each other. And it's a bit strange. It's kind of suggesting like what's actually supporting this AI bubble, which again, folks, I want to highlight how important this is, right? Because this AI bubble, OpenAI and Amazon and Meta and Microsoft, all building these data centers, right, to house the servers and computers for the large language models, like that is driving our economy right now. That was basically most of GDP growth in the first half of the year. And that now seems to be driven by these companies like making deals with each other, often financed by debt. And you have to wonder, how long can this go on for? And if it continues, and if it continues, maybe another quarter, another couple quarters, maybe the party can keep going. But at some point, fundamentals have to rule the day here, everyone. Fundamentals have to rule the day. And the question is, with all the money that these companies are spending on chips and data centers and energy. By the way, the energy required to run these data centers is crazy. I'm going to talk more about that in this video, how much energy is required, the fact that the electricity costs are going up. All of this, right, needs to have a return. It needs to actually produce revenue in the future. And this is what's actually scary. I broke down the numbers on how much revenue potentially these AI companies could generate. And folks, it doesn't look so good. And I want to kind of give you a little bit of a background here. And I want to walk you through this kind of slowly, everyone, because I normally cover real estate, right? But I just want to make sure you all understand what's propping up this economy right now. And why, for instance, maybe the housing market hasn't, fully crashed yet. Why the stock market hasn't totally crashed yet. And it's this capex expenditure by these AI companies, just spending more and more money on the data centers, on the chips, on the energy needed for the data centers. That's what's driving the economy right now. And the scary thing is that according to a new analysis by Bain, the consulting firm, they're saying that all of this infrastructure spending is going to require $2 trillion in annual AI revenue by 2030. $2 trillion in annual AI revenue by 2030 is needed to justify all the capex spending. And I think the estimate is in 2025, it's around 350 billion in capex spending on AI, AI data centers, all the kind of related things, 350 billion. Bain is saying by 2030, we're going to need $2 trillion in annual AI revenue to make this worthwhile. And why this is important, folks, is if we go back to the dot-com bubble, the dot-com bubble happened in the late 90s, early 2000s, right? And, the stock market surged, the S&P surged, the NASDAQ surged, and we ended up having a huge collapse, a massive collapse. The NASDAQ went down 70% over 3 years. 70% over 3 years. Like, think about that. The NASDAQ today is what, like 16,000? Imagine it went to 5,000. Right? That's like what happened back then. And the reason that happened was because there wasn't the revenue to back up the spending. There wasn't the revenue to back up the valuations. And so what I did for you guys and for myself to actually just better understand, like, is this really a bubble? Is the AI bubble really a bubble, or is it justified? I actually broke out the numbers and tried to figure out how much revenue these companies could generate from all their investing in AI. And I think it's really interesting, everyone. Let's take a look at this. So I broke out kind of the big language models. We have ChatGPT, which is OpenAI. We have Gemini, which is Google. We have DeepSeek, which is Highflyer, a Chinese company. We have Grok, which is xAI. We have Claude, which is Anthropic. There's around 1.4 billion users currently. 1.4 billion users currently, consumer users of these large language models, of these AI models, which is a lot. I mean, folks, there's around 8 billion people in the world. There's already 1.4 billion people using these AI models. So clearly there's good penetration already into the consumer landscape. Now, I just said, let's just say in the next 3 years that we were to double the amount of consumers using these LLMs and these chatbots. Let's say we're to double it to 3 billion. Giving them some credit here, we're going to double the amount of users. Just for perspective, Meta has 3.4 billion users. So Meta has 3.4 billion users that they've accumulated over 2 decades. Let's just assume that in 6 years, chatbots get to 3 billion users. Well, if 3% of the 3 billion users become paying customers at $20 a month, how much money is that going to be? And 3%, everyone, just so you know, in consumer SaaS, that's kind of actually a higher conversion rate. 3%. On Reventure app, our conversion rate is actually lower than 3%. Our price point's higher though. Our price point is $40 to $50 a month. But let's just say 3% is what the conversion rate is. ChatGPT actually told me that this was kind of like a midpoint. And $20 a month. That's 1.8 billion in monthly revenue, 21.6 billion in annual revenue on the consumer side. So on the B2C side of AI, we're going to have 22 billion in consumer revenue based on these assumptions. That's the TAM, total addressable market, $22 billion. Not that much, everyone, considering they're investing $350 billion a year in capex. I mean, you could play around with the assumptions. Maybe say 5% of users become paying customers. You guys can let me know. Would you ever become a paying customer to a chatbot? You know, ChatGPT has that plus version for $20 a month. Do you guys use it? Maybe it's $25 instead of $20 a month. Even if you get aggressive, you get 45 billion in annual revenue on the consumer side, on the B2C side. And stick with me through this because I think this is going to help prove a point to you guys about why we're in a bubble right now and why this seems unsustainable. So we got 45 billion, let's just say aggressively, on the consumer side. Now, what about the B2B side, right? Because obviously these chatbots can sell their services, and these companies can sell software and technology and the LLMs to other businesses, right? To optimize other businesses. Well, to figure this out, I just said, what are some of the biggest current B2B SaaS platforms? Google Cloud by Google, 50 billion in annual revenue. Amazon Web Services, Amazon, 108 billion in annual revenue. Google Cloud and Amazon Web Services, everyone basically servers, provides server space and other things for other businesses. And these are like two of the biggest SaaS platforms currently for B2B. Google Cloud and Amazon Web Services combined, it's 150 billion in annual revenue. Then we have Salesforce does 38 billion in annual revenue. Adobe does 24 billion. Microsoft Azure does 75 billion. So, combining the 5 biggest current B2B SaaS products, we have 300 billion in annual revenue. So let's just say the AI market in 3 years gets as big as combined the 5 biggest B2B software platforms. That's 294 billion plus our B2C of 45 billion. That's 339 billion TAM annual revenue. And why this is important, everyone, why, again, I'm taking time to walk you through this so you can understand how this is a bubble. So 340 billion in total AI revenue by 2028, just what my back of the envelope was. They're spending 350 billion a year today in capex, and there's also going to be operational expenses on top of that after they do the capex. Doesn't seem like they're going to get anywhere near $2 trillion in the next 3 or 4 years in terms of revenue, which suggests to me that this is looking more and more like the dot-com bubble. This is looking like a situation where there's all this investment in infrastructure, there's all this investment in compute power, there's all this investment in data centers. Back 25 years ago, dot-com bubble was laying fiber optic wire, was like the big investment. Now data centers are the big investment. So we don't seem to have the revenue potential here to actually make these investments worthwhile. And that's just so important to understand because everyone who's like bullish on AI, they're going to try to tell you like, no, 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 like you don't understand. Like it's just such a big thing. It's going to change everything. And they're going to say like you can't even comprehend how it's going to change everything. That's what they say. The people who are bullish on the stock market, the people who are bullish on AI, they just like kind of just say those things. But we just ran a back of the envelope analysis. It was pretty fair, and we're just struggling to make the numbers work. Now, again, why is this relevant for you out there? Well, let's think about the stock market. Right now, the stock market S&P 500 is like $6,500. S&P 500 index. NASDAQ is what, like, actually, no, NASDAQ is more like 20,000. I said 16,000 earlier, like 20,000. So what is like the backup behind these valuations, right? Of these big tech companies? What is the backup behind the valuations of the stock market? And are we in a stock market bubble? Like, has this AI bubble not only fueled like this industrial capex spending bubble that's pushing GDP growth forward, but is it also creating a stock market bubble that's stimulating a wealth effect that's stimulating consumer spending? And I think this is where stuff gets kind of, again, a little scary because when you break out the data on the stock market, you could see we're in the second largest stock market bubble of all time, according to the Robert Shiller cyclically adjusted PE ratio. And this data goes back about 150 years to 1881. And what it does is it takes the valuations of the S&P 500 and divides it by the cyclically adjusted earnings going back 10 years. And so you can see the CAPE ratio today is 40. This is kind of like the PE ratio I talk about with the housing market. It's the PE ratio of stocks. The PE ratio today is 40. Long-term average is 17. So the stock market is over 2 times overvalued relative to trailing earnings today. Now, again, people who are bullish on the stock market will tell you, oh, you can't use trailing earnings. They'll say you can't use trailing earnings because there's just going to be so much growth in earnings in the future. But remember, folks, we just tried to anticipate earnings growth in the future. We broke out the data on, the AI potential revenue, and it's, I mean, hey, 300 billion. I mean, that's not nothing, but it's not nearly as much as they're spending. So, where is the revenue growth going to come from? Where is the earnings growth going to come from to support the current valuations? And you can see the only other time we had stock prices this overvalued was the dot-com bubble in the late 90s. The Shiller Cape got to 44x. And then it crashed down to 21. I mean, it was a brutal stock market correction. Then it got down to 13 during the GFC. And then it bounced back into the 20s and the mid 2010s. And, you can see we've been in kind of like a raging stock market bubble the last 4 or 5 years. Interestingly, the only other time in US history that we ever had stock prices even close to as high as today in the dot-com bubble was the roaring 20s bubble in the 1920s. Now, this was an interesting period, the 1920s. The big thing in the 1920s was the expansion of electrification. So electricity started in the late 1800s in the US, but it was really the 1920s where electrification really started expanding in a lot of different areas and geographies in America. And there was all types of stocks related to this, all types of hype and boom related to electrification in the 1920s. You should read about it. And basically, these are the 3 biggest stock market bubbles ever. Electrification in the 1920s, the dot-com bubble in the late 90s, and the AI bubble today, mixed with like the Fed printing money the last 4 or 5 years. There's really been no comparison in terms of like how big the stock bubble has been in the past. And so, we're seeing these similarities. The stock prices today are the highest they've really ever been. There's only 2 other points they've ever been this high: dot-com bubble, roaring 20s. In both situations, they crashed. And we're having kind of an infrastructure spend in 2025 related to AI data centers. It looks a lot like the infrastructure spend in the dot-com bubble and in the electrification bubble in the 1920s. And so having that history, I think, folks, helps kind of ground you in what we're dealing with right now. And to be clear, I'm not like totally negative on AI. I think AI is useful. I do use ChatGPT occasionally to help me research. I actually was asking ChatGPT, what do you think the total addressable market is for AI on B2C? And it came up with a number similar to me, around 20 billion to 30 billion. So, you can use ChatGPT to help you. You can use AI to help you, right? Like research things. I'm sure a lot of students are finding AI really helpful. If you're a copywriter, if you're in marketing, I'm sure AI is helpful. Um, but it's kind of limited in its current use case, right? Like this idea that it's this revolutionary technology already that's changing the game completely and completely altering the landscape, I just feel like isn't true. I'm just not seeing it. Like when I try to talk to ChatGPT and ask it to do more advanced things, like sometimes I need help like pulling data sets. Like, can you pull data and put it into Excel? Like, it's just totally, it struggles. It like really struggles. It's actually faster for me to just do it myself. And there's also been a lot of people talking about recently how sometimes maybe like the models are degrading in quality. I've heard some people talk about that. Like, are they having to start to ration tokens? One thing we haven't talked about yet, but I want to talk about now is the energy that's required to run all of this, right? The energy that's required to run these servers, run the computers, run the data, and then also to cool these systems is insane. And there was actually a really interesting article talking about that because this is like another potential bottleneck here is the uh, the energy cost, like the electricity cost. And I think Bloomberg recently had an article on this. Yeah, AI data centers are sending power bills soaring. And again, you folks can let me know what you think. Um, There's some interesting comments here in the chat that I'm going to talk about soon. But AI data centers are sending power bills soaring, right? So this is actually just like a real crisis happening in a lot of areas right now. They're building these data centers often in states like Virginia and Pennsylvania and Ohio. And look at this, everyone. Wholesale electricity costs are as much as 270% more than 5 years ago in areas near data centers. This is analysis from Bloomberg. And this is actually kind of cool, everyone. They show basically what the price of electricity was. I believe this is milliwatt hour in 2020, and then what it was in 2025. And so you could see the big Midwest increase in electricity costs right there. Let me just show you, folks. Like Columbus was $17 per milliwatt hour in 2020. Now Columbus is $35. It's doubled. But if you get even more granular, which they did, wholesale prices more than doubled since 2020 in some markets, but the increases aren't felt equally. Areas with the biggest jumps like Baltimore are near data center hotspots. And they kind of go into it a little further and they find that, the closer you go to a data center, the more that your electric bill has increased. And they say here in the US, the power consumption from data centers, power demand, is going to double by 2035 and be almost 9% of all power demand. Some predict it will be the biggest surge in US energy demand since air conditioning caught on in the 1960s. That comes as the grid is already struggling. So this is like another issue with AI is that it's so intensive on energy, and it's kind of like, all right, there's two issues with that. Number one, is that like worth it for society to have the power bills for regular Americans go up just so these data centers can run? Like that's the first thing, right? You guys can let me know what you think about that. Should these AI data centers just be allowed to be built all over the place? They show here, this is another really interesting graphic. They show basically the closer that what they call LMP nodes were to within data centers, the more that the cost increased, right? And the further away you were from data centers, the less that the cost increased. So it's kind of a double-edged sword. If they're building these AI data centers in your area, in your state, there could be a temporary increase in jobs, right? There'll be construction jobs, and there could be some ongoing operational jobs, but maybe that's the upshot for yourself economically. But the downside is that your electricity costs, if you're in that area, are going to go up. And this is something I'm seeing more and more politicians talk about, like Ron DeSantis, the governor of Florida, has been talking about this a lot more. Like, should we be watching and maybe monitoring and maybe regulating how many of these data centers open up? And should we be making sure that we don't have the electricity bills of regular Americans skyrocket just because these data centers are going in there? The other issue with the power side of the equation is it's also going to be a limiter potentially on how much these AI models can do. Like if we can't increase the power supply enough to allow these AI models and the data centers to be built and improved, it's just going to cap their improvement in terms of what they can do. And if the AI models don't get better or significantly better, then they're never going to really generate the revenue that people are expecting. So I think, folks, net, I think AI in the short term can be a useful tool, right? But there's all of these headwinds that no one's talking about, right? The energy, right? Like not only is it expensive, but it's going to cap just how much the AI can do in the short term. And then the revenue assumptions, like how are we even getting close to 2 trillion in annual revenue from AI investment by 2030? Like it doesn't, like just doing the numbers, it doesn't even make sense. And I just think this is such an interesting topic. Again, folks, I know I typically talk about the housing market. I will talk about the housing market here in a second. I just think this is a fascinating topic that you all need to understand. And one other kind of point here about the AI bubble, right? We talked about the infrastructure spend. Meta, Amazon, OpenAI, Oracle, they're all spending, right? Capex, that's pushing GDP growth up. But we can't forget the stock market bubble component of this, right? So the S&P 500, right, it's at 6,600 today. It bounced back 1.6% today from its losses. And you could see like, wow, the stock market just keeps going up. And everyone thinks the stock market's going to keep going up, right? And why do they think it's going to go up? Well, obviously this AI bubble is a huge component. But what I think is also really interesting is this stock market bubble, in my opinion, is driving consumer spending. And one of the reasons why consumer spending is still strong. Consumer spending really hasn't fallen off. Consumer spending is 70% of GDP, right? And what we have now is we have the top 10% of earners driving a growing share of consumer spending. So in case you're someone who's been like confused about how come, again, the economy hasn't crashed, like it feels so bad out there for so many Americans after 3+ years of inflation. We have a really weak job market right now. If you're trying to find a job, especially in a white collar industry, in a professional services industry, it's really hard, right? So how do you square the fact that this economy hasn't crashed, that stocks haven't gotten much cheaper, that home prices still haven't gotten much cheaper in most cities, in some cities they have? Well, it's because the top 10% of earners are driving a growing share of US consumer spending. So according to Moody's, 50% of consumer spending is now done by consumers in the top 10% of the income distribution. And that used to be like 36% of the spending was done by the top 10%. Now it's 50%. And what I believe is driving this is the fact that the stock market keeps booming, right? And it's the wealthiest Americans that own the most stocks. And so as the stock market keeps booming, you're actually going to support consumer spending in the top 10% of earners and the top 10% of wealth. And right now, that is supporting our economy on the consumer spending side. So you have the wealth effect in the stock market driving consumer spending forward, keeping it afloat among the wealthiest Americans. And then you have the AI infrastructure spend that's juicing GDP growth. Obviously, they're building equipment and hardware and the shell for the data centers and all that kind of stuff. So it's those two things which are driving the economy. And again, the question is, are those two things sustainable? Are they sustainable into the future? And I'm just really skeptical about that. Everyone tries to tell themselves that like, oh, it's all good. Like, don't question the stock market. Don't question these things. But when you just apply some scrutiny to it, it doesn't really make a whole lot of sense. It feels like more and more of the US population is getting hollowed out. More and more of the US population is getting kind of hollowed out, is struggling, can't afford to pay their bills, can't afford the electricity, can't afford the rent, certainly can't afford to buy a house with a mortgage, right? Can't afford that. Maybe 40, 50, 60, 70% of people feel that way. But then the top 10, top 20% keep spending. And then, oh yeah, we have the big infrastructure spend on AI capex. Who knows how that's going to play out? And I want to be clear, folks. I don't know how this is going to play out. I can't say for sure it's a bubble that's going to crash. But neither can these people doing the spending say for sure it's going to work. And like this is the whole thesis of this video. Like we already have Sam Altman, Jeff Bezos, and Michael Dell coming out starting to question it, right? You already have like the big guys coming out questioning it. Sam Altman saying, oh, this kind of looks like the 90s. Michael Dell saying, well, we're not going to always need more data centers. Jeff Bezos saying it's an industrial bubble. And I guess if it's an industrial bubble, it's better than a financial bubble because at least there's some positive. Like, folks, maybe I'm wrong. Maybe maybe, just maybe, we're going to get, maybe this is going to be the biggest thing since sliced bread, these AI data centers. And maybe 15 years from now, we will be very happy and grateful that they were built. Like maybe it could be like the US interstate highway system. This was the other thing I was researching. The US interstate highway system in the late 1950s, the Federal Highway Act of 1956, 1957, really appropriated the funds and made sure that like the federal highway system got built. Now, that was at a cost. What was the cost here? Federal highway system. Federal highway system cost, inflation adjusted. Let's see here. According to Google Gemini, the cost of the federal highway system was around $618 billion in 2023 dollars. Now, for comparison, everyone, the cost of AI, capex, and infrastructure spending has already exceeded 618 billion. So the amount spent on AI, data centers, and all that stuff, energy, has already exceeded the cost to build the interstate highway system in inflation-adjusted terms. And that just happened over like 2 years, 2 or 3 years. Obviously, I think, the interstate highway system is interesting because there was a lot of people who did not want it to get built. Right? They had to take land, right? They had to seize land from people, break up neighborhoods. They had to bulldoze neighborhoods. I think 50, 60 years later, as a country, we're probably happy that the interstate highway system got built. But, I don't know. I'm just not seeing that like AI is such a no-brainer as the interstate highway system, right? Like, who knows? I could be wrong. Maybe in 10 years, like every single person will be using AI like all day. And we're going to be so happy that the data centers were built. I'm just not seeing it, and I'm not seeing the revenue potential to justify the capex spend. And I think this is a bubble. And I think when the capex spend slows, which I suspect maybe we'll do in the next year, you're going to see some crazy stuff potentially happen in the stock market and economy once all of a sudden people start realizing, oh, wait a minute, this wasn't going to continue at this rate for the foreseeable future. And it could be like the dot-com bubble, where very quickly stock prices go down, we enter a recession. So, I think those are the risk factors that you guys need to know about. Now, how does this impact the housing market? How does this impact the housing market? I know some of you are ready to, leave requests for the housing market in your area. Let's talk about the housing market in your area. And we can also talk a little bit more about AI here, everyone. I'm ready to open up the chat. This is a very active chat. Let's see what people are saying. We have Texas Cannon saying AI is going to continue to grow exponentially. Why do you say that? Why is it going to continue to grow exponentially? I'm curious why you say that. Another person is saying every software will have AI in the future. It will be like using a computer without internet. Oh, okay. So we have some people who are kind of bullish. PhillyNet says, doesn't Wall Street demand growth in earnings to infinity? I don't know what that means. Earnings to infinity. Well, earnings is simply a function of your revenue minus your expenses. And so again, I think the thing we're struggling with on AI is, where's the revenue coming from? Even the person who said every software will have AI in the future, right? Like, that's a huge claim, first of all. But let's just again look at the biggest B2B software companies now by annual revenue, like Amazon Web Services, $107 billion a year in revenue. Are we saying AI is going to be bigger than Amazon Web Services in a matter of 2 to 3 years? It took Amazon decades to build this. It took Google decades to build Google Cloud. It took Salesforce decades to build Salesforce. It took Adobe decades to build Adobe. It took Microsoft decades to build Azure. These are the biggest B2B software revenue companies and products today, right? And the only one in the hundreds of billions is Amazon Web Services. So this is my point. It's like you could say, oh, AI is going to be in everything. But what does that mean in terms of revenue? You got to start backing it up with numbers. And I think this is what bothers me about it. The people who are basically like, oh, AI is going to be everything. They just say these generalized things like, oh yeah, it's going to be in every product. What does that mean in terms of revenue? We put some back of the envelope numbers, and it doesn't seem like the numbers are going to be there. Let's see. Jim has an interesting comment. He says the data centers could be converted into residential units. Maybe we could do an adaptive reuse on the data centers. Well, one issue actually with the GPU chips, everyone, is that they have a short useful life. So they're buying all these GPU chips from NVIDIA, and they're going to start to buy them from AMD. And these chips within 3 or 4 years are worn out and obsolete. This is the other thing, right? So they're spending all this money on these chips. They're going to have to replace these chips in 3 to 4 years. The depreciation, it depreciates in 3 to 4 years. I'm just not seeing it. Texas Canon says AI is new and prone to errors. That's true. Let's see. Yeah, I saw an article where the CEOs have not found the ROI yet. I don't think anyone's found the ROI. Again, that's why, folks, OpenAI, they're just kind of warning you, everyone. Oh, hey, just in case you guys, don't get mad at us. We told you that there's a bubble, right? Jeff Bezos, hey, I called it a bubble, so don't get mad at me, right? Michael Dell, hey, at some point I told you there'd be too many data centers. So, when it happens, when it bursts, I told you, right? And again, the big kind of warning sign is this chart, everyone. It's the fact that all these AI-based companies are doing all these like deals with each other back and forth. Like OpenAI is investing NVIDIA is investing 100 billion in OpenAI, who's then ordering the chips from NVIDIA, right? So NVIDIA produces the chips, sells the chips to OpenAI, but NVIDIA is now investing in OpenAI. That's strange. OpenAI is going to deploy 6 gigawatts of AMD GPUs. AMD gives OpenAI option to buy up to 160 million shares. So OpenAI is going to buy AMD GPUs. In return, OpenAI is going to become an owner of AMD. Seems like a lot of circular revenue going on here, folks. You guys can let me know what you think. Here's a comment. LLMs, what we're calling AI, is a statistical model. It will not replace anything that's a specific step-by-step process. That's an interesting point. I agree. I think some of the people are overrating what AI can actually do. It's really good at doing research, right? It's really good at copywriting. Is it good at doing things beyond that? I don't know. Another person says, "Our poor planet being extracted for minor convenience AI solutions?" That is a funny comment. It's actually an unfortunate comment. It's not a funny comment. It's an unfortunate comment because I think you're right. Again, we talked about the electricity costs, right? All the electricity and water that's needed. And I imagine, like, what percentage of uses on ChatGPT are actually like legitimate versus like people who are just bored? Like, how many of ChatGPT users are just using it as a replacement for scrolling on Instagram Reels, right? And who are just kind of like, I want to talk to someone, so I'll talk to AI. Another person says, if you don't think CEOs will replace your job with AI the second they get, oh boy, tell that to the cashiers in 2000s. So that's an interesting point. And I think the big one here was the CEO of Ford, who said 50% of white collar jobs are going to go away. I talked to you guys about this before. Ford CEO Jim Farley stated in June 2025, again, we're using Google Gemini here, that artificial intelligence is likely to replace half of all white-collar jobs in the United States. He made this prediction alongside warnings about the shortage of the workers' economy and the essential economy, which includes skilled trade. So you have the CEO of Ford saying half of all white-collar jobs are going to go away due to AI. Now, is that true, everyone? Like, is that actually true? And I reported on this a couple videos ago, everyone. I think to a certain degree it's true. Like, one area we're looking here is software development. Software development, and I tracked this data set from Indeed. Software development, it's like one of the big industries where AI is hitting first, right? So like, it really, AI does improve the efficiency of coding and software engineering to a certain degree. And, one thing I think is kind of interesting is, right, like you would think the demand for software developers in the US would be skyrocketing right now, right? With all the investment in AI, all these tech companies surging, right? You would think, oh, the demand for software developers would be going way up. It's not. Software developer job openings on Indeed have gone down 70% over the last 3 years. And software developer job openings on Indeed are down 37% from where they were before the pandemic, which is wild. So there's 37% fewer employers looking for software developers today than 2019, 2020. And this is like, a warning of like, yes, that clearly AI is having an impact here. Like the marginal demand to hire a software developer in the US is probably lower due to the fact that AI is making existing developers more efficient. And this is like another thing that shows me this is a bubble, right? Because at some point, if your core industry is tech, and this is the industry that's supposedly booming right now, how are we not hiring any software developers? I mean, that's shocking to me. And yes, intellectually, I get it. Like, AI is decreasing the marginal demand to hire a new software developer. But with how much money is being spent in AI, how much the stock valuations of these companies are going up, you would think, wouldn't they be hiring software developers just in case? Like, wouldn't they be like hiring software developers to like train on AI? Instead, they're doing the opposite. Like Microsoft, just laid off, wasn't it like 11,000 people earlier this summer? In July. Yeah, in July, Microsoft laid off 9,000 employees in their latest round of cuts. Microsoft will cut less than 4% of its global workforce across teams, role types, and geographies. So this is funny, folks. What's Microsoft's market cap? What's Microsoft's market cap? $3.8 trillion. $3.8 trillion. Their stock is up 134% the last 5 years. It's up 22% the last year. Yet they're laying off software developers. And again, folks, I would just ask you, like, if this was legitimate, if this was not a bubble, and the CEOs of these companies like truly believed that this was durable, why would you be laying off 10,000 people? Like, wouldn't you just say, hey, let's just hold the talent? Let's just do a company training module for the next 2 years on AI. And wouldn't we just train all the developers? They have so much money, like earnings are so high. Why wouldn't they do that? Instead, they're laying the developers off. I don't know, folks. That just smells to me like deep down, a lot of these CEOs don't actually really believe that this is durable. Because if this was durable, right, and this led, say, in 2 years to an economic boom, which is, I think it has to, right, for this to be, for the bubble to be like not a bubble, and for the valuations to be legit, I mean, this has to lead to some type of economic boom, right? The capex spending is going to have to convert to some type of productivity increase. It's going to cause companies to then hire more people, right? That's the only way that this kind of like makes sense in it not crashing, right? Well, if that was going to happen, why wouldn't you just hold on to your employees for 2 years? And instead, if you think it's going to be better in 2 years, you're going to be frantically hiring people in 2 years. Why wouldn't you just retrain your company and set up learning modules, put your employees in AI training for the next 2 years? Why wouldn't you do that? I think that's kind of funky that they're kind of really just cutting people when their stock prices are surging. Oh, chat is very active right now, everyone. So someone says here, this is all wrong. It's not that AI isn't turning a profit or creating value. Companies make money with AI by saving on labor plus monthly subscriptions. AI is massively profitable for a select few companies. So I get the logic here. You're saying like, oh, the whole idea behind AI is that they could lay off the labor. The problem is that's not sustainable from an economic standpoint. So individually, if all these companies lay off the labor, we're going to have a job market like firing recession, and consumer spending is going to go down and their revenue is going to go down. So I don't truly believe that the model here is just lay off all the labor. Like, that's not a sustainable model. That's like a model for a year or two. We're going to get more efficient. At some point, you need to have projects that are producing revenue. Again, these companies are spending $350 billion this year on capex spend for AI. Cutting some costs on labor and getting some consumer subscriptions is not going to make up for that. So we need a lot more than that to make this justified. Shane says Microsoft has over 225,000 employees. 10K could be for anything. Realignment, bloat. Could be. But again, Shane, I would say, think about, again, the whole idea here. If Microsoft truly believes that the future is bright in terms of technology, right? Why wouldn't they retrain their employees? I actually know some people who got laid off personally in that layoff. I've talked to some of them. Some of them have master's degrees. Some of them have master's degrees in computer science who they laid off. And it's kind of sketchy. It's like, why would you lay off people with master's degrees in computer science? Why wouldn't you try to train them in what you need to train them for? Luxury Bucket List says only the strong will survive. They can rehire in the gig economy. That's an interesting point. It does feel like the economy in general is becoming more like a gig economy. You guys can let me know what you think about that. But yeah, it does kind of feel like the relationship between employee and employer has broken down somewhat. I've talked to some friends about this. They said it started in 2008. Like in 2008, was like the first big wave of mass firings, right? And there was a lot of trust broken between employee and employer. And since then, it just seems to be going more and more that direction. In 2020, 2021, when there was that hiring boom, initial stage of the pandemic, lots of people in tech just like jumped to a new job every 6 months. They didn't really care about the companies that hired them. Now, clearly the companies that hired, the tech talent don't care about them. And so maybe it's just kind of like a gig economy. That's an interesting point. Uh, yeah. All right. Let's get into the housing market, everyone. How about we talk about some housing market data? I know we just talked about AI for about 45 minutes. All right. Can you do assessment on Wilmington, North Carolina housing market? I'm looking to buy in the next 18 to 24 months. 28401. Get your request ready, everyone. We are going to look at some housing market data. 28401. Wilmington, North Carolina. What's going on here in Wilmington, North Carolina? Well, let's just zoom out here. Are we in the right area? I think we are. In Wilmington, values are down 3.3% in the last 12 months. So for those of you that don't know, Wilmington, near the beach, eastern North Carolina, it's also pretty close to South Carolina. Values here are down 3.3%. Now, it depends. If you go to Wrightsville Beach, values are up, but in central Wilmington, values are down. Now, where are we going to forecast prices heading in the next year in Wilmington? Minus 2.9% is our forecast. So we have a bit of a little mini correction going on here in Wilmington, North Carolina. Already down 3.3% in the last year, minus 2.9% in the next 12 months. So could be a good time to start negotiating. In terms of overvaluation, we think prices here are 10% overvalued. So hey, 10% overvalued. They've gone down by 3.3. We think they're going to go down by another 2.9. Maybe start negotiating, submitting some lowball offers, see if you can get a good deal. What else, everyone? Wilmington. Values are going down in Wilmington. I wouldn't have expected that. How about Redding, California, 96003. 96003, Redding, California. And folks, California is a state that I think is kind of negatively impacted by a lot of this. So, California is obviously the epicenter of AI and technology, right? And a lot of people own stocks in California, a lot of wealthy people in California in the tech industry. But that slowdown in software developer hiring is definitely having a drag on California's economy. Here in Redding, values are flat. Now, Redding, folks, this is true Northern California. We're almost up in Washington. I believe they have some issues with wildfires up here. Is this near Mount Shasta? It might be. Values are flat over the last year. In some of these areas to the east, values are down 3 to 8%. In terms of the 12-month forecast, really, we go east into the mountains. Our forecasts are heavy negative, but here, more towards Shasta Lake, flat. Flat forecast. Based on inventory. Inventory here is up, but it's not up enough, right? So inventory is up to 129 homes, but prior to the pandemic, there's 156, right? So there's still kind of this inventory. I'm not going to call it a shortage anymore, but we're not yet at the surplus inventory level. And then in terms of days on market, let's look at days on market. We can see DOM is up. We're up to 59 days on market. So that is starting to slow the market here, the DOM. So I wouldn't expect a crash here, but it is starting to slow. If you were to buy more towards the east of Redding, you'll have a better luck finding a deal. What other areas, folks? Oh, here's an interesting one. Louisville, Kentucky. Not Louisville, Louisville. Louisville, Kentucky, 40219. Louisville, home of Colonel Sanders. I don't know if you guys knew that. Louisville's home of Colonel Sanders, famous from KFC. And then Muhammad Ali as well. His grave is in Louisville, Kentucky. Also home of a lot of bourbon. Now, folks, Louisville, the values are up a lot the last year. Like, take a look at this, everyone. The zip code this user just had me look at. Values are up 5.9%. Louisville is actually one of the strongest metro areas over the last 12 months. Especially these urban locations are doing really well. I think a lot of investors are descending on Louisville. The question is this going to continue? What's our forecast look like? And it's not going to continue in the same way. Our forecast is now tilting negative, minus 1.7% here in this zip code to the southeast of downtown Louisville. So we don't think this area is going to crash, but it's definitely shifted, right? It was a seller's market for the last 2 years, right? Now it's back into a buyer's market, biggest buyer's market in 8 to 9 years here in Louisville. So we think, at Reventure, we think the prices are going to start tilting down. It's going to become a better opportunity for you to buy in Louisville going forward. How about, what other areas here? Good point. Northern Virginia could have some exposure to tech as well as the government layoffs. Another commenter says this is probably most like the railroad bust in the 1870s that led to a long recession, which ran from 1873 to 1893. There was a massive investment in railroad and there was not enough revenue. That's a really interesting analogy. I'll show you some data on that in a second. But let's get to some more requests. North Augusta, South Carolina. North Augusta, South Carolina. Did you guys know there was an Augusta in South Carolina? I thought there was just an Augusta in Georgia. But we have, I guess it's the border? It's the border. So basically, the southern side of Augusta is in Georgia, and the northern side is in South Carolina. Is that right, everyone? I didn't know that. Wow, that's correct, everyone. So Augusta, that's where the Masters is. Northern side, Aiken County, South Carolina. Southern side, Richmond County in Georgia. Home value growth in the last year, we're down minus 2% in Richmond County, minus 0.3% in Aiken County. So we're starting to go down in Augusta. Whoa, boy, you can see we have a lot of negative in and around this area and some of these rural locations in Georgia and South Carolina. Prices are dropping as much as 7 to 10% year over year. They're down only 2% in Augusta. Where do we think in the next 12 months it's going to go? Minus 2.1%. Minus 2.1% in the next 12 months. Minus 2.1%. So interesting. I would have thought the home values in Augusta here would have been higher. Let's see here. I'm going to just do a little deep dive here. This is where they have the Masters, right? Am I right about that, everyone? This is where they have the Masters tournament. You guys can let me know. All right. What other requests do we have? Aspen, Colorado, 81611. This is fun. Aspen. Have you guys ever been to Aspen? Do you guys ski? Let me know here in the comment section. What's going on in Aspen's housing market? Oh, folks. Typical home value in Aspen. You want to guess? $3.3 million. My goodness. $3.3 million. It was like $1.9 million prior to the pandemic. Now it's $3.3 million. A lot of rich people who own AI stocks buying up ski homes and ski chalets in Aspen, I guess. Well, what's our forecast? Our forecast is actually plus 2% in the next year in Aspen. Why is that? Well, the inventory in Aspen is still low. We were at 425 homes prior to the pandemic, only at 278 homes today. What's the sales activity look like, though? What's the demand to buy in Aspen? Demand is kind of down from the peak, but kind of normal. So this market still is not really showing signs of a correction yet in Aspen, Colorado. 3.3 million, that is crazy. In the crash phase, like let's just look all over Nashville. Our 12-month forecast in Nashville is minus 6%. It was minus 7, now it's minus 6. So it got a little bit better in the last month, a month and a half. But Nashville, Lawrenceburg, Lewisburg, Central Tennessee, we see some big declines coming in the next year. We see some declines coming in Memphis as well. We see declines coming in Asheville. This whole area here in the Southeast, this whole pocket's really started to slow. Ultimately, good news if you're a buyer in this area. Prices have started to get cheaper in most of these locations, will likely continue to get cheaper in most of these locations. All right, everyone. What else, everyone? Oh, Spring Hill, Florida. Spring Hill, Florida. This is a fun little market, 34608 Spring Hill. I drove up through this market a couple times on some road trips, filmed a couple videos near here. Now, is this near Brooksville? Yeah, Brooksville's over here. I filmed a video in Brooksville. Spring Hill is just to the west. Well, values in Spring Hill are down around 4% in the last year. 34608, they're down 4.7% in Spring Hill, 4.7% drop. So Florida's market, folks, oh boy, it's turning out a bloodbath in a lot of parts here of Tampa, St. Pete, up to, this is Hernando County, I believe. down 4.7% in the last year. What's our 12-month forecast in Spring Hill? You guys should definitely check out this forecast on Reventure app. Minus 9.3%. Oh boy, this is a big downward forecast we have here in Spring Hill. My gosh, what's going on with inventory? Is this going to be a hockey stick in terms of inventory? Well, yeah, it's gone up a lot. Lots of homes for sale here. That's good news if you're a buyer in Spring Hill, Florida. Negotiate hard. You should be able to get a deal. All right. How about housing prices in Siberia? Reventure app does not yet cover Siberia. We would like to do an international expansion at some point. Probably going to have to go to Canada first before we get to Siberia, but maybe Canada and then the UK, then Siberia on our international expansion list. 75024 Plano, Texas. 75024 Plano, Texas. What is going on in Plano, Texas? 75024. And folks, this is data you can all access at www.reventure.app. I'm going to show you in a quick second how you can access this data for yourself. 75024 here. We're north of Dallas, everyone, in Plano. And you could see, wow, a lot of declines happening in the DFW metro, especially to the south, to the east. We have a little pocket here to the north, Highland Park, University Park, where values are still going up. But pretty much everywhere else, they are going down. In Plano, they're down 3.4% in the last year. I believe, is this where Legacy West is in this zip code? I believe it is, down 3.4% in the last 12 months. Now, our 12-month forecast going forward is minus 2.4%. So we think this decline is going to continue. Interestingly enough, folks, this zip code here, north of Dallas in Plano, 3.4%. This is the biggest one-year drop that we've seen in the last 25 years. Wow. So, this is an area that's typically pretty stable. The values went way up during the pandemic. We have the biggest one-year drop in 25 years. Obviously still expensive, but we still think these declines are going to continue. It's going to get more affordable for you in this market, everyone. And what I would suggest you guys do, as I take another request here, let's actually take another request. San Diego, 92115. Ooh. San Diego, this is a tough market because it's so expensive to buy in San Diego. Beautiful part of the country. Love San Diego. But, well, you can actually see it's getting cheaper. So values are down 3.6% in the last 12 months here, northeastern section here of San Diego, near La Mesa, to the west of La Mesa, east of Normal Heights and Kensington. Values are down 3.6%. That's actually the biggest drop. Excitingly, that's the biggest drop since 2011. So, prices are still high here in San Diego, but they are going down here in this zip code, 3.6%. And we think they're going to go down 6.4% in the next 12 months. So that is encouraging. That suggests that you're going to find some more deals looking to buy in this area over the next year. And what I would really encourage you guys to do is upgrade to Reventure app Premium so you can access all this data for yourself. On Reventure app Premium, you can track home prices in every zip code in the US. You can identify overvalued and undervalued markets. You can access our one-year price forecast, which you can see right here, our one-year price forecast for every zip code to know where the market's heading, and also get the full suite of market trend metrics, all for only $49 a month, everyone. That's less than 0.01% of the cost of buying a house. I mean, in San Diego, that's less than 0.005% of the cost of buying a house. Ultimately, this is going to save you a lot of money on your home purchase. Until next time, everyone, go to Reventure app, www.reventure.app. Also download our mobile app, and I'll talk to you guys soon.